Welcome back. It's that time of the morning when we try and analyze some of the important stock moving news. And we have an expert with us, Gurmeet Chadha, Managing Partner and CIO at Complete Circle, joins us. Good morning, Gurmeet. Pleasure having you with us. Thanks for that. May I start with the chemical stocks? Anupam Rasayan numbers were good, so were Tata Chemicals. Do you track the space closely, and are these results impressing you?
Yes, in fact, Tata Chemical is one of our portfolio stock in the PMS we run. I think while despite the run up, I think the stock still trades at about 15, 16 times FY24 EPS. If you see the business mix, it's 75% basic chemistry, which is your soda ash, sodium bicarbonate, salt, etc. And 25 odd percent is specialty chemical, which also includes, the agrochemical business through Rallis and the new chemistries they are getting into, including the EV battery, etc. I think the mix continues to improve. The specialty chemicals, I think, going forward will form a large part of the mix. So if you see current quarterly turnover of 40 to 4,300 crores, almost 3,200 crores is basic chemicals. Also, the soda ash prices remain firm because the end use demand is very good, which is from glass and infra, etc. And also, there is no new capacity expected before FY25, which will support, the soda ash prices. And Tata Chemical is almost the third largest. So I think it remains a more reasonable stock within this space, and probably it can sustain few quarters. Probably you'll see more re-rating on the stock, the like we saw in Deepak and some of the others.
Okay, that's on Tata Chemicals. A good set of numbers. I wanted your thoughts also on SBI Card. The credit costs remain elevated for SBI Card, right? I mean, it's over 5.6%. But other than that, numbers are not too bad. Income growth of almost 28% year on year, profit growth of 52%. What do you do with a stock like this?
No, I think it's a mixed set of numbers, and I think we should not focus too much on revolver credit, because what happens is in the festive season, this ratio can get, slightly elevated or dispersed depending upon. So right now, because there's a festive season, I think once the spends mature, even the revolver share is basically people who don't pay full and keep rotating, right? And that contributes more to the card companies. I think if you see overall, I think whether it's in card in force or their spends by market share, they're still at 18, 19%. I think what probably I want to see is that provisioning, and if that trends continue or just a one-time thing. And as Lata also pointed out earlier, that it's a standalone card business, so you have to be more, the impact on any regulatory thing is more pronounced, especially in this case. But very good names. Their ROAs have been around 5%. Valuations are not that stretched, and I think overall with this UPI integration, etc., and this is just a standalone play on card business. There's no other pure listed entity per se if you want to play the credit card business. So we remain constructive on it, not bothered too much by just one quarter blip on provisioning and revolver credit. Thanks.
Okay, Gurmeet, you were listening in. What do you make of the stock?
I think it's been a great turnaround under his leadership since Blackstone exited it in 2018. And, this is apparel export. So they have like 36, 37 million pieces capacity, and 80% sales is US. And they have some large clientele, including, Gap and H&M. So I think continue to do well. In fact, we interacted with him in one of the Motilal events, and he actually pointed out to 1,500 crore additional revenue through the capex they have done. And I think it gels with the overall big theme also, which is this China Plus One and the government focus on textiles through various initiatives, including PLI. I think there could be maybe a 1 quarter, 2 quarter hiccup in terms of how global trends are playing out. But some of it's probably in the price still at 13, 14 times FY24 earnings. So
Absolutely.
pretty reasonable. So we are quite constructive on this space.
Okay, Gurmeet, the place to be in the last fortnight has been banks, right? I mean, just look at the way some of these banks have moved. Canara Bank at a fresh high. RBL Bank was up 10% yesterday. From this entire lot, the broader market banks I'm talking about, which one do you still like for more upside?
So, you have to now start looking at, the corporate loan also along with the retail growth. And I think one bank which is standing out in the PSU space is SBI. They've been talking about, the unavailed limits of almost 6 lakh crore. the new corporate book at 1.5 trillion, which obviously largely is both tier and working capital. And obviously retail is picking up. So we like that. We also like IDFC amongst the smaller ones because, the not only the retail book has grown 5x, both on deposits and advances, the legacy assets are also down. And I think some of these legacy borrowings will come down in the next 2 years, adding to NII. Still trades reasonably despite the recent uptake, and continue to like the old favorites, which is ICICI. I think HDFC is due once the merger hangover is done. Probably some of it should come through.
All right. Thank you very much, Gurmeet, for these explanations. But please don't go away. We have more questions for you. A quick break, and the technical experts, Mitesh Thakkar and Shrikant Chauhan, will also join.